In this video, we're going to take a look at a brand new options-based, high-yielding ETF that was just introduced last month. This high-yielding dividend fund has a target yield of 15% and it also pays monthly distributions. What's more is that the underlying holding that it uses its option strategy on is one of the best performing stocks in the market and has consistently beat the S&P 500 over the decades, which is Berkshire Hathaway. If we compare the S&P 500's performance to Berkshire, we can see it has a very long history of beating the index. This can all be credited to the successful stock picking of Warren Buffett. So today we're going to examine the VistaShares Target 15 Berkshire Select Income Fund, ticker OMAH or OMA, which is a nice reference. I've gotten a few requests to review this over on our Patreon, so let's figure out how this fund works and if it's a worthy consideration for income investors. According to this fund's page, it says it seeks income and secondarily, long-term capital appreciation. This fund strategy involves two components. First is investing in a portfolio of equity securities based on the sole active VistaShares Berkshire Select Index, and two, generating income through an options portfolio. Primarily through the fund's option strategies, the fund will seek to achieve an annual income target of 15% distributed monthly. So we need to figure out a couple things here, including what is the sole active VistaShares Berkshire Select Index and how is it able to pay a fixed 15% per year in dividends. For starters, these target income ETFs are still somewhat of a brand new type of investment. The oldest target income fund that I could find came out in 2018, but these kind of ETFs have really been picking up in popularity over the past couple years, especially now that a lot of the new target income funds are now offering exceptionally high yields. A lot of the big name players in the high dividend ETF realm, including Defiance, Roundhill, and now YieldMax, offer their own target income funds. VistaShares appears to be a brand new company with only one other ETF in their lineup, which is some generic AI fund that doesn't appear to be too special. The size of the company doesn't matter though, as long as the fund abides by what's in their SEC documents. So let's take a look at the sole active VistaShares Berkshire Select Index, because basically what's in this index, this ETF is going to use its option strategy on. It's an index that was created by a company called Sole Active, which is a company that specializes in creating stock indexes for companies. It says, the sole active VistaShares Berkshire Select Index represents the 20 highest valuation equity securities from the portfolio of the holding company, which is Berkshire Hathaway. This index gets this information from Berkshire's 13F filings, which are reports that institutional investment managers who manage at least $100 million or more are required to file every quarter with the SEC. So when Berkshire provides a new list of their holdings to the public, then changes to this index are made. You can find a list of Berkshire's most recent holdings by doing a Google search, which is a lot faster than using Edgar. The VistaShares ETF, as you can see, holds all of the same companies as Berkshire. The top holdings inside of this fund would include Apple, American Express, VeriSign, and a lot of other stocks that Warren Buffett's been a big fan of. One interesting thing about this ETF though is that 10% of its portfolio is dedicated to holding shares of Berkshire Hathaway directly. I tried looking for a reason as to why they decided to dedicate this specific percentage to holding this stock when it's already exposed to the other holdings inside of this VistaShares ETF, but I couldn't locate anything in their prospectus about this. So now that we know all about this index fund and how its holdings are selected, how is OMA able to provide a fixed 15% yield? As I mentioned earlier in the video, target income ETFs have been around for a few years, but these higher yielding target income funds came out much more recently. An example would be SPYT, which is a fund that generates income through option premiums derived from selling S&P 500 index call spreads. They sell at the money or near the money call spreads to retain upside growth potential and aim for a target annual income level of 20% with this ETF. Another example is BIGY by YieldMax, which has a target 12% annual yield. They surprisingly don't go into too much detail on their strategy and just say they use options contracts to receive income in the form of a premium when they write an option. By selling options, the fund will earn premiums from buyers who pay for the right to buy or sell the underlying asset at a predetermined price. But back to the Berkshire fund, this is the option strategy that it lays out in its prospectus. The fund earns income by collecting the premiums from selling, writing options. When an option is sold, the buyer pays the fund for the right to either purchase or sell the underlying asset at a predetermined price. The advisor employs different option strategies based upon its market outlook, selecting one or a combination of strategies that it believes will achieve the fund's income target, while also allowing for potential capital appreciation, growth in asset value. The advisor also evaluates the performance of the underlying securities when choosing option strategies to deploy. The specific option strategies the fund employs may alter its overall risk and return profile, affecting volatility, income, and potential for capital appreciation and the preservation of capital. For instance, by writing covered calls, which is selling call options on securities already held by the fund may limit its potential gains in exchange for premium income. So OMA is actively managed, and the investment managers are basically saying that they intend to use a wide range of different option strategies depending on how they think the market is doing. But I'm going to assume that the strategy they'll use most often will be the same as what Defiance uses with SPYT. The reason I suspect that is because both Defiance and Vista shares overlap in terms of investment advisors. There's an odd connection going on with Vista shares and several other high-yielding fund providers. The same investment advisor for this company is the same as Defiance, which is Zega Financial. Also, one of the fund managers for this ETF is Jay Pestricelli. He's the guy responsible for YieldMax. How is one guy connected to so many ETFs offered by so many different companies? But my point is, this ETF is probably very similar to SPYT and BIGY in terms of strategy. There's 2 or 3 risks that are associated with this kind of strategy that this ETF is pursuing. The first is, during bear markets or just when the market is down in general, these funds usually have a harder time regaining in share price compared to other options-based ETFs. If we put OMAH next to Berkshire stock, you'll see that at least from a share price perspective, it's down more than the investment it uses its option strategy on. That's not unusual, but if we compare the S&P 500 with a covered call fund like SPYI and the S&P 500 Target Income Fund SPYT all side by side, there's significantly less upside with the Target Fund. However, if Berkshire Hathaway does continue its long history of outperformance, then OMAH could fare much better in terms of share price appreciation over the long term. There's another threat that exists for this ETF, and it would be almost impossible to confirm if this is going on or not. But most of the dividends paid by this ETF are classified as return of capital. Now, I've explained in previous videos that return of capital is simply a tax classification. Some funds that derive their dividends from options-based strategies are allowed to classify their distributions as return of capital. My concern, though, is if this fund doesn't earn enough during a specific month to pay its target distribution, then could some of this ROC actually be the more traditional type of ROC, which is when a fund is returning capital to their investors, or basically eating itself up? This is something that would likely be impossible to know, so that is another risk. Finally, we have to address Warren Buffett's age here. He's turning 95 in August, and sadly, when he's no longer able to serve as CEO of Berkshire, that means someone else will have to try to continue in his footsteps. In 2021, Buffett named who he'd like to be his successor, which will be a guy named Greg Abel. Abel has been with Berkshire for over 25 years, and he's been preparing to carry the torch at some point. If the board does approve, then only time will tell if he has the skills to keep delivering Berkshire's superior returns. So all things considered, I'd say I'm choosing to be optimistic about this ETF. I like Buffett and I like Berkshire, and I'm hopeful this fund could do better than SPYT and QQQT and other target income funds. I'm standing off to the sidelines on this for the time being to give it some more months to provide more of a track record. I want to see its strategy play out, and the market that we're in right now is pretty tough. I should have mentioned this earlier, but given the fact that nobody knows who this company is, I think it's important to mention that this is not a sponsored video. I haven't been compensated whatsoever by this company to talk about this ETF. But let me know what your thoughts of OMA are and if you think it's a worthwhile investment. But with that being said, that's going to wrap up today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.